Here's 5 things I wish I knew starting out in equity research for anyone looking to become an investment professional or just understand how the professional investing world works. This is based off my 7 years as an equity research analyst. So number one, like most jobs in finance, equity research is performance driven. Now, when I first started out, I unfortunately didn't realize this. I remember I came in one day and I was actually pretty hungover. I went out the night before. I was feeling very sluggish. That morning, Apollo Education, a company that we cover, had just reported their earnings and the stock was down 20% before the market opened. So once I hit my desk, calls were coming in left and right. I got connected to a portfolio manager and immediately he's asking me, what is going on with Apollo? Why is it down 20%? And my brain just wasn't working. So I just said something like, I think the stock has missed some kind of expectations. And he's like, what expectations? Tell me what it is. And I just remember thinking like, I don't know, but I just told him, I'm pretty sure it's whatever investors were expecting is what they missed. And he was just quiet for a second and then he hung up. So embarrassing. From that point onwards, I always made sure I was well rested because I realized once you get into the office in equity research, you got to be able to think on your feet. You got to be able to help investors with their decisions in real time, anytime you're in the office. Number two, the job is not to research, but it's to help people make decisions. So when we were covering the education sector, we would put out a 220-page report on the sector with every kind of stat that you can imagine. Everything from spending in the industry, what degrees are growing, what age groups, everything compiled into this giant data book. But this information only became valuable when it was used in a way that helped investors select a stock. So for example, Strayer back in 2014, this company had just transformed their strategy. They lowered their tuition, started partnering with corporations to educate working adults. And we were able to use the information from that big data book to make a case that Strayer was in a great growth area for working adults. That was the only space where degrees were still growing. They also had good quality education based off metrics like the debt to earnings ratios of their graduates, as well as student loan default rates, all pointing to these programs are getting students jobs. And so the company was back to a growth trajectory. The point is, this information only became valuable because we were able to use it in a way that helped an investor select Strayer as a stock for their portfolio. I remember realizing this a couple years later in 2020. So this was the COVID pandemic. A lot of workers got furloughed. So a lot of retail workers were temporarily laid off. And that was like a big component of Strayer's new student demographic. But a lot of investors actually didn't realize this. They just bought up an education stock thinking that this would benefit from a recession. So everyone was caught by surprise when Strayer's management went on an earnings call, put out just one sentence of guidance for enrollments to be down 27% the next quarter. So their growth of enrollments was going from that 15% rate all of a sudden to a negative 20% growth rate. This stock was trading around 150 at the time, and it got right back down to 100. And I remember a fund manager called in. This guy is a very aggressive investor. He asked me directly, okay, Henry, where's this piece of going? Do you think it can go down to $70? Because I understood Strayer's model. I had all the information related to the education sector. I was able to calculate the impact to Strayer's earnings per share, as well as identify the multiple of a market downturn to be able to price the stock. And yeah, it actually did come out to $70. Once we're done with that conversation, and he started to short the stock, and ultimately, it did go down to $70. So the point is, you're doing research not just for the information, but to help investors or portfolio managers select stocks or make a decision on their stocks. Number three, always know the drivers. So when I first started out, I was covering about 30 plus stocks on the sell side. I was just completely overwhelmed. Couldn't really keep up with the press releases, the earnings calls and transcripts. It actually took 1 to 2 years before I realized that you can actually simplify most businesses down to just 1 or 2 things that'll grow the business and will grow the stock. For example, a company like Gartner, they sell research to corporates, to their IT functions, and they grow by hiring salespeople at the rate of between 8 to 10% a year. And with productivity improvements, which help salespeople generate more sales, they're able to grow earnings at a rate of about 15% each year or so. And so once I started to talk like that with investors, and that was just me simplifying the story just to 1 or 2 factors, all of a sudden I started getting comments from sales like, oh, wow, Henry really understands his stocks really well. He's so helpful. Because that at the core of it is the job of the analyst. You need to understand what information is most relevant. And then once you take that information, you understand what's important, you can start to develop a view. I remember at the end of 2020, I actually helped a hedge fund analyst structure an investment going into 2021 for Gartner. So, just for context, they had acquired a business called CEB with the plans of turning it around, and it was taking longer than expected. There was finally some signs that this business was recovering, and the overall spending for IT research looked like it was potentially improving as well, just because the environment overall was improving. We could see that there was a case for Gartner to report much better earnings than what consensus expected. And that's how we structured a case to buy Gartner at those 150, 160 levels right before the earnings recovery, which took the stock well beyond that up to the 200 plus and 300 levels. From understanding the drivers, we're able to position an investment right before that change. Number 4 is have a strong personality or opinion. Now, this is more specific to the sell side where you have to gain attention and build relationships with clients. And I remember this one time I was at a conference. We're all getting drinks, all of us analysts, and we're all bored. A company presentation can only be so interesting. But one analyst, man, he was dynamic. He was joking around with the waitress. He was flirting with her. He had really blue eyes. So she was asking him like, hey, is your eye color really that blue? Are you wearing contacts? And he's like, no, no, no. You don't believe me? Touch my eye. Touch my eye. Right? It's crazy. And he was just such a fun time to hang around with. So it turns out he actually has no problem getting any business with clients. Management teams love traveling with him. He's always able to put together meetings and bring companies to meet investors. His calendar is packed for the year. In a context like this, with a company conference, all the analysts are probably going to say the same thing because we all have the same information, but he has such a strong personality that he's able to stand out. I started to realize this myself when I went out and made a really, really aggressive recommendation on a stock. It was a financial data company, MSCI. I could see back in 2020 that ESG, or environmental social governance investing, really was starting to take off. I believe that that was a really big trend for the investment industry. And MSCI was a leader in ESG data. They'd invested it for many years. So I went out really aggressively telling investors that you need to buy this stock right now. I had put together the data and the evidence and put together the numbers to make a case that this stock could go all the way up to $500. So I was pounding the table, telling investors you need to buy this right now. And guess what? That type of an aggressive call actually got a lot of attention. The press picked it up, Barron's picked it up, salespeople loved it. They loved pitching it. And I got a ton of calls from really big name funds asking about this recommendation. And the stock actually popped as well right after the recommendation. Once you get to the point where you have your own view and you can express it, do it with a very strong personality and a very strong view, because that will get you attention. Number 5 is be the axe on the name. So what the axe is in the trading and research world is that you are the go-to expert on that name. Whether for your client or for your portfolio manager, they come to you for insights and advice on what to do with the stock. That's where you want to get to. Get really curious, follow that curiosity, and go deep on something. So remember that big data book that we provided for the education sector? I was actually putting together a lot of the data. And so I really went in deep on all sorts of things, understanding regulations in the education industry, understanding trends in demographics, understanding the different quality of degrees. So I really had a deep understanding of the data. So when JP Morgan came to us and was looking at an investment in the education space, we were the natural fit. And every week I kept getting requests for suggestions from the analysts because they were looking at a company called DeVry and they were starting to put together their research to put together a case for the stock. So every week I gave them different charts and tables. And ultimately at the end of that process, because we built up this trust, I remember he called me one day and he's like, thank you so much for all the data. I just have a question for you. What does your gut say about the stock? This is the first time that a big name investor with a lot of money is actually asking me for an opinion. So that was like a really big deal for me at the time. What that implied is now I'm a trusted advisor for that investor. And what I told him was, honestly, I didn't think DeVry was that great. Didn't think they were in a great space. I didn't think their programs were really that excellent relative to other companies. And so ultimately, JP Morgan, they passed on that company. DeVry's stock never really went anywhere. And instead they invested in a childcare company, which actually did really well. And so every quarter from that point onwards, I would always get a call from that team asking for my opinion. And I would always get a vote each quarter because our team was the axe on the name. And that's ultimately what you want to get to as an equity research analyst, either on the buy side or sell side. If I had known a lot of these 5 things before, I probably could have accelerated my path to get there a lot faster. I hope you enjoy this and like and subscribe if you do, because you can see more of these. And I'll see you in the next video.